Imagine watching the IRS quietly slice $10,000 right out of your retirement account on New Year's Day, simply because you missed a single calendar deadline. For decades, your pre-tax money compounded completely untouched, but turning age 73 triggers a mandatory tax harvest that most retirees completely misunderstand until penalty notices arrive. While recent federal legislation reduced the misdistribution penalty from 50% down to 25%, that lower rate is actually a carefully disguised behavioral trap. Most financial headlines celebrate this lower penalty, yet they ignore how a single calculation error can quietly derail 30 years of careful portfolio compounding. If you want the real story behind money, subscribe to the channel right now, because today we are breaking down this exact mechanics, and let's get into it. Meet Robert, a 73-year-old retired mechanical engineer sitting on an $800,000 traditional IRA. He painstakingly built over 4 decades of disciplined factory work. For 40 years, Robert enjoyed an unwritten contract with the government where his capital grew tax-deferred, provided the Treasury eventually collected its deferred income tax. That collection mechanism is the required minimum distribution, a legally mandated annual withdrawal designed specifically to drain pre-tax accounts over your statistical life expectancy. Using IRS Uniform Lifetime Table 3, Robert divides his prior year-end balance of $800,000 by a distribution factor of 26.5 to determine his payout. The math dictates an exact required withdrawal of $30,188 for his first year of mandatory distributions, which must leave the account before the deadline. While normal annual distributions must happen by December 31st, first-timers like Robert get a confusing grace period extending to April 1st of the following year. Taking that April extension means taking 2 separate taxable payouts within a single calendar year, easily pushing retirees into a much higher marginal tax bracket. Trying to avoid double taxation, Robert plans to withdraw his $30,188 by late December, but a sudden hospitalization causes him to completely miss the New Year deadline. Because $0 left the account on time, federal law instantly assesses an excise penalty equal to 25% of the entire shortfall amount. 25% of Robert's missed $30,188 withdrawal equals a staggering $7,547 penalty owed directly to the Internal Revenue Service upon filing his taxes. Before the Secure Act 2.0 passed in 2022, that exact same mistake would have triggered a brutal 50% fine of $15,094. While 50% caused instant panic and swift corrections, 25% lulls retirees into assuming the penalty is just an unavoidable administrative fee they must quietly absorb. Crucially, paying that $7,547 penalty does not satisfy the original tax liability, because Robert must still withdraw the delayed $30,188 and pay full income taxes. Between the 25% penalty and the 22% federal tax bracket, almost half of that mandatory withdrawal instantly evaporates into government coffers. However, Congress embedded a hidden escape valve inside the new law that can slash that 25% penalty down to just 10% if executed rapidly. To qualify for this 10% reduction, you must withdraw the full missed amount during what the statutory text defines as the timely correction window. This window opens the exact day after your missed deadline and strictly closes on the second anniversary of that taxable year, or when assessed by notice. By taking his corrective distribution immediately in January and filing the proper paperwork, Robert drops his penalty from $7,547 down to just $3,018. That crucial paperwork is IRS Form 5329, specifically Part 8, which tracks additional taxes on excess accumulations in qualified retirement plans. Never assume that just withdrawing the late money alerts the IRS. If you skip attaching Form 5329, automated computers will eventually demand the full 25%, yet even paying that reduced 10% penalty is often unnecessary if you understand how to leverage the statutory reasonable cause waiver. Under Section 4974, the IRS maintains discretionary authority to waive the entire penalty when a shortfall stems from reasonable error and swift corrective action. Robert's unexpected hospitalization qualifies as textbook reasonable cause, provided he includes a formal letter of explanation alongside his zero penalty Form 5329 submission. However, your account custodian also sends Form 5498 directly to federal regulators every May, reporting the exact fair market value used for these strict calculations. If that reporting discrepancy triggers an automated audit before your waiver arrives, the burden of proof shifts entirely onto your shoulders, which raises a critical question about multiple accounts. Let's examine the exact financial damage on a realistic $120 million retirement account when that strict December 31 deadline passes without a withdrawal. If your required distribution for that year is calculated at $44,000, missing that transfer triggers an automatic $11,000 excise tax bill instantly. Notice that this $11,000 penalty is not ordinary income tax, but an additional federal levy tacked directly onto what you already owe. You still have to withdraw that original $44,000 and pay regular income taxes on every dollar, compounding your overall out-of-pocket cash loss. Most retirees incorrectly assume the IRS will send a gentle reminder notice before assessing such an aggressive financial punishment against their nest egg. In reality, the tax code operates on a strict self-reporting system where you must proactively declare any missed distribution on Form 5329. Why does Washington enforce a 25% penalty when failing to pay standard income taxes only costs 0.5% per month? The mechanism goes back to the original deal you struck with the government when funding those pre-tax accounts decades ago during peak earning years. Congress allowed your money to compound tax deferred for 40 years solely on the condition that they eventually collect their deferred revenue before you pass. Without a punitive hammer forcing withdrawals, wealthy households would simply treat tax-deferred savings as permanent, multi-generational wealth transfer vehicles entirely shielded from taxation. This dynamic is precisely why custodians like Fidelity or Schwab are legally mandated to report your exact year-end account balances directly to federal regulators. They file Form 5498 each May, creating an unmistakable electronic audit trail that tells the IRS exactly how much you were supposed to withdraw. When your tax return arrives without the matching distribution income reported on line 4B of Form 1040, automated computers immediately flag the discrepancy. Here is where many diligent savers stumble into the aggregation trap when managing multiple separate retirement accounts across different brokerage firms. If you own 3 traditional IRAs, you can total up their combined required minimum distributions and satisfy the entire amount from just one single account. However, that generous pooling rule completely disappears the moment you introduce a former employer's 401k or 403b plan into your overall retirement portfolio. Every individual 401k strictly requires its own standalone distribution, calculated specifically from that particular plan's December 31 balance from the previous calendar year. Taking an extra $20,000 from your primary IRA will never cover the mandatory withdrawal required by an old 401k left at your past job. Another dangerous point of failure involves automated monthly withdrawals, set up precisely to satisfy the required minimum distribution before the year closes out. If your target calculation changes due to market volatility or life expectancy adjustments, fixed monthly transfers can easily fall several $100s short. Even a minor $500 shortfall triggers the 25% penalty on that exact unwithdrawn balance, costing you an unnecessary $125 fine right away. Fortunately, the Secure Act 2.0 did introduce a crucial relief mechanism that lowers this harsh penalty from 25% down to just 10%. To qualify for this reduced 10% rate, you must correct your missed distribution within a specific 2-year statutory correction window. That correction window begins on January 1 immediately following the missed deadline and ends on the exact day the IRS assesses the penalty tax. First, you must immediately withdraw the entire shortfall from your retirement account as a distinct separate transaction clearly labeled for that prior year. Never combine a make-up distribution with your current year's regular RMD, because mingling the funds creates massive confusion during an IRS compliance check. Once the funds are safely deposited into your taxable checking account, you must file Form 5329 alongside your federal income tax return. Here is the contrarian secret that most standard tax software programs fail to clearly explain to aging retirees navigating this stressful penalty process. Section 4974 allows the IRS to waive the entire penalty down to $0 if you can prove the shortfall was due to reasonable error. To request this complete waiver, write RC on the dotted line next to line 55 on Form 5329 and attach a detailed explanatory letter. To grasp the sheer mathematical brutality of this penalty, let us examine a 74-year-old retiree holding a $120 million traditional retirement account. Using the official IRS Uniform Lifetime Table Divisor of 25.5, their mandatory withdrawal for that specific year comes out to exactly $47,058. If a sudden hospitalization or simple administrative oversight causes our retiree to miss the December 31st deadline entirely, the trap springs. The federal government instantly levies a flat 25% excise tax directly on the unpaid $47,058 balance, creating an immediate $11,764 fine. Understand that this $11,764 charge is not an advance payment of your standard income tax bill, it is purely a punitive forfeiture. When our retiree eventually corrects the mistake and withdraws that delayed $47,058, they must still pay ordinary federal and state income taxes on every dollar. Combining a 24% marginal tax bracket with a 25% penalty means losing nearly half of that annual distribution to IRS enforcement. That single clerical error destroys years of careful compounding, wiping out over $23,000 of retirement purchasing power in one painful blow. However, Congress recently introduced a vital safety valve under Secure Act 2.0 that most aging investors have not fully grasped yet. If you discover the missed withdrawal and take the required funds within a specific statutory correction window, the penalty drops from 25% down to 10%. This critical correction window begins right after the missed deadline and stays open until the second anniversary of that exact tax year. In practical terms, for an uncollected 2024 distribution owed on December 31st, your window to secure the lower 10% rate closes on December 31st, 2026. There is one major catch. If the IRS audits your account and issues a formal notice of deficiency before you self-correct, the 25% rate locks in permanently. To claim this 10% reduction, you must withdraw the exact deficit immediately and file a revised Form 5329 with your federal tax return. For our retiree facing that $11,764 penalty, acting within the correction window slashes the excise tax down to $4,706, rescuing over $7,000 of wealth. Yet even a 10% penalty remains an unnecessary leak in your financial bucket that smart planning can completely prevent from ever happening. Where most wealth builders stumble after age 73 is navigating the intricate aggregation rules across multiple different retirement accounts. If you own 3 separate traditional IRAs, the IRS allows you to calculate the required distribution for each, combine them and withdraw from just one account. This aggregation privilege offers immense flexibility for rebalancing portfolios, letting you liquidate assets from whichever traditional IRA holds excess cash or overvalued stocks. However, that exact same aggregation rule does not apply to 401k or 403b workplace retirement plans from former employers. If you hold 3 old 401k accounts, federal law mandates that you calculate and satisfy each plan's RMD strictly from that specific individual account. Withdrawing the combined $30,000 total requirement from just one 401k leaves the other 2 accounts severely non-compliant and immediately subject to the 25% penalty. Many retirees assume their CPA or financial advisor will track these distinct account balances automatically, but legal responsibility rests entirely on your own shoulders. Consolidating scattered workplace accounts into a single traditional IRA before reaching age 73 is often the smartest administrative move to eliminate structural complexity. Now, let us examine the powerful automated surveillance mechanism that the IRS deploys to detect misdistributions without any human intervention. Every May 31st, your account custodian must submit Form 5498 directly to federal tax authorities, reporting the exact fair market value as of December 31st. Box 11 of this mandatory document explicitly checks whether an RMD is required for you during the upcoming calendar year based on your birth date. When you file your Form 1040, the IRS supercomputer crosses your reported distribution income against the exact calculations derived from those mandatory Form 5498 filings. If your actual withdrawals fall short of the required threshold by even $100, an automated flag triggers a computer-generated deficiency notice. You cannot hide from this digital matching system, which is why proactive tracking and timely execution are essential for preserving lasting retirement wealth. Let's examine how the calculation formula itself becomes a trap for careful retirees holding multiple accounts across different brokerage firms. Your exact distribution amount equals your prior December 31st account balance divided by your life expectancy factor from IRS Table 3. At age 73, your divisor is 26.5. Meaning a $1 million retirement portfolio requires a mandatory withdrawal of exactly $37,735 this tax year. Here is the hidden danger. While you can aggregate all your traditional IRAs and pull the total withdrawal from just one account, 401ks operate differently. If you hold 3 separate 401k plans from former employers, the IRS demands that you calculate and withdraw the exact required minimum from each plan independently. Taking your combined 401k distribution from a single account triggers the 25% penalty on every single dollar you failed to withdraw from those other specific accounts. However, a powerful exception exists if you are still working past age 73. The IRS allows you to delay required withdrawals from your current employer's retirement plan. This delay only applies if you own less than 5% of the company. Owners and partners must begin withdrawals at 73 regardless of employment status. Savvy investors who continue working past 73 often roll their traditional IRAs into their active 401k specifically to legally shield those assets from mandatory distributions entirely. Now consider the treacherous calendar trap that catches millions of retirees during their very first year of eligibility for required distributions. For your initial distribution year only, the tax code grants a special extension allowing you to wait until April 1st of the following calendar year. If you turn 73 this year and delay your initial withdrawal to next April 1st, you must also take your second mandatory withdrawal by December 31st. Forcing 2 massive taxable withdrawals into one single calendar year can artificially spike your income, pushing you into higher tax brackets and triggering Medicare surcharge penalties. An extra $50,000 of distribution income can increase your annual Medicare Part B and D premiums by thousands of dollars through IRMAA income surcharges. That is precisely why seasoned financial planners almost always recommend completing your very first withdrawal by December 31st of your 73rd year to spread the tax burden. Suppose the December 31st deadline passes and you suddenly realize an account was forgotten. Panic often causes retirees to make costly administrative blunders right away. Never simply ignore the oversight hoping the IRS computer fails to notice your missing Form 1099-R reported by your brokerage custodian. Your exact first step toward eliminating that 25% penalty is immediately withdrawing the entire missed distribution amount directly from your retirement account. Next, you must file IRS Form 5329 for each specific tax year the required distribution was missed, even if you are requesting a full penalty waiver. On Part 9 of Form 5329, report your required distribution amount and the shortfall, but write the code RC and enter 0 on the final penalty line. That 2-letter code RC stands for reasonable cause, which signals to the IRS examiners that you corrected the error and are formally requesting penalty abatement. Alongside this tax form, you must attach a concise formal letter explaining the exact reason behind the oversight and proving your corrective withdrawal. The IRS routinely approves waivers when the delay stemmed from serious illness, death in the family, or documented administrative errors committed by your financial institution. Do not enclose a check paying the 25% penalty when submitting your reasonable cause waiver request, because recovering paid penalties requires a tedious refund process. Even if your waiver request is denied, correcting the shortfall within the statutory 2-year correction window guarantees your penalty drops automatically from 25 to 10%. Historically, missing an RMD carried no statute of limitations if you never filed Form 5329, leaving retirees exposed to audits decades after the actual error occurred. A Secure Act 2.0 completely overhauled that trap by establishing a strict 3-year statute of limitations that starts running right when you file your Form 1040. Another vital mechanism involves Roth accounts. While lifetime Roth IRAs have always enjoyed complete exemption from required distributions, employer Roth 401k plans previously faced mandatory withdrawals. Beginning in tax year 2024, federal law officially eliminated required lifetime minimum distributions across all employer-sponsored Roth 401k and Roth 403b accounts entirely. Yet while your personal retirement accounts now enjoy clearer protection, the most complex and heavily penalized rules actually govern accounts inherited by your surviving beneficiaries. To completely erase that daunting 25% penalty, you must execute a precise IRS administrative procedure using Form 5329 under Section 4974. Before you even draft your waiver request, you must immediately withdraw the exact missed distribution amount directly from your retirement account today. On Part 8 of Form 5329, enter your full required minimum distribution on line 54, followed by your actual shortfall on line 55. Write 0 on line 55 next to the waiver code RC, signaling to the IRS that reasonable cause justifies forgiving your entire penalty. Never pay the 25% penalty upfront when requesting an abatement, because sending cash immediately traps your money in a months-long processing bureaucracy. Legitimate reasonable cause requires documenting severe unexpected events, such as prolonged medical hospitalization, cognitive impairment, or the sudden loss of an immediate family member. Another ironclad defense involves custodian errors, where your brokerage firm mailed an inaccurate withdrawal calculation statement that directly caused your missed deadline. Simply stating you forgot or didn't understand the age 73 rules will result in an immediate rejection letter from IRS automated processing systems. Your explanation letter must concisely structure 3 clear facts: exactly when you discovered the mistake, how quickly you withdrew the cash, and your new safeguards. Secure Act 2.0 finally established a strict 3-year statute of limitations, meaning the IRS cannot audit your missed RMD forever once you file correctly. Under previous tax laws, omitting Form 5329 left your return open indefinitely, allowing compounding penalties and interest to silently accumulate against retirees for decades. If your waiver gets rejected, the statutory correction window gives you exactly 2 years from the missed deadline to lock in the 10% rate. That valuable 2-year correction window closes immediately if the IRS issues a notice of deficiency before you finish pulling the required money from your account. When managing multiple traditional IRAs, you can calculate each required amount separately and withdraw the entire consolidated sum from just one single account. However, you can never combine 401k minimum distributions across separate workplace plans, as every single 401k account requires its own distinct annual withdrawal. Missing a required withdrawal inside an inherited IRA triggers the exact same 25% penalty, while also entangling you in strict 10-year depletion rules. If you remain employed past age 73, the still working exception legally lets you postpone required withdrawals from your current employer's 401k plan until retirement. Yet this still working exemption completely disappears if you own more than 5% of the company, instantly forcing mandatory age 73 distributions regardless of employment status. To satisfy your annual RMD without adding a single dollar to taxable income, execute a qualified charitable distribution up to the annual $105,000 limit. Because charitable transfers bypass adjusted gross income entirely, they protect your hard-earned Social Security checks from falling into the punishing 85% tax bracket. Automating your required distributions into predictable monthly transfers eliminates late December panic while permanently removing the human error that leads to missed deadlines. Monthly withdrawals function like reverse dollar cost averaging, methodically smoothing out market volatility across 12 separate transactions instead of risking one poorly timed December liquidation. You can also use a strategic December RMD withdrawal to cover your entire annual tax bill by directing the custodian to withhold 100% for taxes. The IRS legally treats retirement withholding as paid evenly across all 4 quarters, perfectly erasing underpayment penalties even if taken on December 31st. Your most powerful long-term defense against massive future RMDs is executing systematic Roth conversions between age 60 and your mandatory start date. Shifting $500,000 from traditional IRAs to Roth accounts during early retirement permanently eliminates over $20,000 in forced annual taxable income once you hit age 73. Without proactive planning, sudden RMD spikes easily trigger the IRMAA tax cliff, inflating your Medicare Part B and D monthly premiums by thousands of dollars. Earning just $1 single over an IRMAA threshold locks you into a full year of higher Medicare surcharges, turning a simple RMD into a financial disaster. You can slow RMD growth through strategic asset location by holding high-yield equities inside Roth accounts while keeping stable bonds in your traditional IRA. Ultimately, securing your compounding wealth requires building an automated RMD defense system with dual calendar alarms well before the final December deadline hits. The ultimate defense against IRS penalties is setting up automated systematic withdrawals directly through your custodian dashboard early in the calendar year, well before December arrives. Scheduling your distribution for early October builds an essential safety buffer against unexpected brokerage processing delays during the hectic holiday rush. If an inadvertent mistake occurs, remember that the IRS routinely waives the penalty for retirees who submit Form 5329 with a reasonable cause letter. Your written explanation must clearly document the exact medical or administrative hardship that caused the missed deadline, proving you corrected the error immediately. Crucially, do not pay the penalty check upfront when requesting an abatement. Attaching payment often causes automated IRS computers to reject your waiver application. Beyond simple penalty avoidance, savvy wealth builders use qualified charitable distributions to satisfy annual required minimums, while legally stripping up to $100,000 of taxable income. By transferring pre-tax IRA funds directly to a qualified charity, your adjusted gross income stays low, shielding your Social Security benefits from higher taxation rates. Keeping your reported income low also prevents monthly Medicare Part B and Part D premium surcharges from silently draining your retirement cash flow each year. True financial peace comes from treating retirement accounts not as passive savings, but as structured distribution engines designed for lasting wealth preservation. Consolidating scattered IRA accounts before turning age 73 eliminates administrative complexity and prevents multiple institutions from miscalculating your annual withdrawal requirements. By mastering these mandatory distribution rules today, you transform a rigid government deadline into a predictable paycheck that secures your golden years with confidence. Protecting your nest egg from that IRS penalty requires proactive automation. Hit like if this helped you today, and comment below, what age will you start taking distributions? Subscribe now for more calm, lasting wealth strategies. Next week we reveal why Roth conversion ladders can completely eliminate your future mandatory withdrawal tax burden.